Hey everyone, I'm Yusuf Topal. Today we're going to delve into the dusty pages of history, but don't worry, it won't be boring. Because we're going to talk about one of humanity's greatest weaknesses, financial bubbles. Imagine, an investment everyone chases after, everyone thinks they'll get rich, then bam, everything disappears in an instant. In this video, we'll examine history's biggest financial bubbles and the brutal but important lessons they teach us. From tulip mania to the dot-com bubble, we'll see how people make the same mistakes over and over again. But why? Why do people get caught up in these bubbles, and how can we take precautions? We'll search for the answers to these questions together. Get ready because history might be about to repeat itself, and this time, it's good to be prepared. We're in the Netherlands in the 17th century. During this time, the Netherlands is experiencing its golden age. They're making huge advancements in trade, art, and science. Tulips everywhere. Tulips of all colors and varieties decorate everything. But these aren't just any tulips, especially rare varieties like the Semper Augustus are worth a house, a car, even a whole fortune. These tulips attract attention with their rarity and beauty. Now you might be thinking, wait a minute, it's just a tulip. How expensive can it be? But these tulips are much more than ordinary flowers. You're right, normally they shouldn't be. But things were a little complicated back then. People hoped to make huge profits by investing in these tulips. The Dutch economy is booming and people are wondering where to invest their money. With the increase in trade and wealth, they start looking for new investment opportunities. That's when tulips enter the scene. These flowers quickly become a major investment tool. At first, these flowers, admired by a few wealthy individuals, quickly become a status symbol. Tulips become a sign of wealth and prestige. Everyone is investing in tulip bulbs, and the prices are skyrocketing. People hope to make big profits with these tulips. People are selling their houses and everything they own to buy tulip bulbs, burning with the dream of getting rich. This craze quickly turns into a huge bubble, but they forgot one thing: it's a bubble, and every bubble has to burst sooner or later. This financial madness eventually ends in a huge crash. And the expected moment arrives. Tulip prices suddenly start to fall. First a slight dip, then a crash, and finally complete panic. People try to sell their bulbs, but it's too late. Tulips, once worth a fortune, are now worthless. Thousands of people go bankrupt, their dreams shattered. The Dutch economy takes a long time to recover from this shock. So, what does tulip mania teach us? First, it shows how dangerous speculative investments can be. Second, the value of an investment shouldn't just be based on supply and demand, but also on its real value. Remember, if something goes up too fast, it can come down just as quickly. Tulip mania is an important example for understanding the many financial bubbles throughout history. We're in 1920s America. Jazz music, dancing, and lots of money. Everyone's in the stock market, everyone wants to get rich. People are mortgaging their homes and cars to buy stocks. The stock market keeps going up. It seems like everyone's winning, no one's losing. Newspapers have headlines that say, "The stock market will go up forever." People start to see the stock market as a sure thing, but behind the scenes, warning bells are starting to ring. The real value of companies is much lower than their stock prices. Overproduction and the use of credit are creating a bubble in the economy. And then, in October 1929, the infamous Black Tuesday arrives. On Black Tuesday, the stock market completely crashed. Millions of dollars in stocks lost their value instantly. People panicked and tried to sell their stocks, but it was too late. The Great Depression had begun. Banks failed, unemployment skyrocketed, and people lost their homes. The United States and the world experienced one of the greatest economic crises in history. So what does the Great Depression teach us? Most importantly, it shows us how dangerous excessive borrowing and speculative investments can be. It also highlights the importance of correctly reading economic indicators and analyzing risks. The Great Depression serves as a painful reminder of how vital financial literacy is. Hey everyone, today, we're going on a trip back to the golden age of the internet, the year 2000. We're going back to the year 2000, the wild west of the internet. Back then, the internet was like an undiscovered gold mine. It was a time when everyone was building a website, and investors were throwing money at them like crazy. Everyone was racing to catch the next big thing. The future of the internet looked bright, maybe a little too bright for some. The tech world was pushing the limits of imagination. People were investing in anything with a .com at the end. Everyone wanted a piece of this new world. A website that sells pet food, millions of dollars, easy. These kinds of projects were investor favorites. A website for taking care of digital pets? Sure, why not? Logic? Looking for logic wasn't very popular back then. Nope, nobody cared back then. Everyone was just looking for a quick buck. Everyone was looking for the next Amazon or Google. Anything was fair game to catch the big fish. And of course, one reason for this craziness was the media. Newspapers, magazines, television. Everyone was inflating the internet bubble. The media was constantly praising this new economy. They were talking about something called the new economy. This new economy seemed to be breaking all the old rules. It was like the laws of physics had changed, and money was growing on trees. Everyone was looking for an easy way to get rich. But the truth is, many .com companies were built on dreams with no foundation. These dreams quickly turned into nightmares. They didn't have business plans, they didn't have revenue models, and in some cases, they didn't even have a real product. There were only big promises and empty hopes. There was just a website and a lot of hype. It was only a matter of time before this bubble burst. And then, boom! The .com bubble, inflated with great hopes, burst. Everyone believed the internet was the future. The bubble popped and we saw the truth. Many companies vanished overnight. Offices emptied, employees lost their jobs, many .com companies went up in smoke, investors lost their money and disappointment followed, stocks lost value, investors lost their money, and sadness fell over Silicon Valley. The tech world took a big hit. So, who survived this disaster? Which companies weathered the storm? Companies like Amazon and Google. They weren't just websites, they had a real business model and a vision. Because they weren't just websites. They had a real vision, a solid business plan, and real products that added value for their customers. They had a real vision, a solid business plan, and real products that added value for their customers. This was the most important factor that set them apart. The .com bubble taught us an important lesson. All that glitters is not gold. We learn not to be fooled by appearances. When investing, you need to look not just at trends, but also at the fundamentals of companies. Sustainability is more important than hype. Long-term thinking is essential. And then there's this. Ordering pet food online, it seemed like a revolutionary idea back then. Not so revolutionary after all, right? Some innovations only look good on paper. Sometimes the old ways are better. Traditional methods always provide a sense of security. 2008. America, shaken by the mortgage crisis. But how did this happen? People were living the dream of owning a home, house prices had gone through the roof, everyone was investing in real estate to get rich, but there was a problem. Who was going to buy these houses? The answer is simple: no one. Banks were giving out loans that were impossible to pay back. These loans, called subprime mortgages, were given to people with low credit scores, sometimes even to people with no income at all. Yes, you heard that right. Home loans to people with no income. Everyone thought the value of these houses would just keep going up. But when the bubble burst, millions of people lost their homes. Banks were on the verge of bankruptcy and the world economy collapsed like dominoes. The 2008 crisis showed us in a painful way just how fragile the financial system is. So what's the lesson from the 2008 crisis? First, financial literacy is essential. How does credit card debt work? What is a mortgage? If you don't know the answers to these questions, you're at great risk. Second, there's no such thing as easy money. If an investment promises you very easy or very fast money, there's probably something wrong. Remember, if something seems too good to be true, it probably is. Third, diversification is important. Don't put all your eggs in one basket. You can reduce your risk by spreading your money across different investments. Finally, don't hesitate to seek help from experts. A financial advisor can help you determine the right investment strategies. The year 2021 was the peak of cryptomania. Bitcoin was breaking record after record, Elon Musk was tweeting about Dogecoin, NFTs were selling for millions of dollars. Everyone wanted to get rich with crypto. But not everyone could be a winner in this digital gold rush. NFTs, or non-fungible tokens, were touted as the new way to invest in digital art. Suddenly, everyone was buying pictures of monkeys, pixelated characters. But this craze didn't last long. The NFT bubble, like others, burst. So were cryptocurrencies a bubble, or are they the currency of the future? Time will tell. But one thing we know is that the cryptocurrency market is extremely volatile and risky. It's really important to be careful when investing in the cryptocurrency market. There's a lot of manipulation and scams in this market. Before investing, always do your research and know how much risk you can handle. Also, don't fall for FOMO, fear of missing out. You don't have to invest just because everyone else is. Instead of blindly following trends, do your own research and think long-term. Remember, investing is a marathon, not a sprint. Be patient, do your research and make informed decisions. Otherwise, you might find yourself a victim of the next financial bubble. If history has taught us anything, it's that financial bubbles are inevitable. Human greed and fear cause these bubbles to inflate and eventually burst. But informed investors can ride these waves without getting hurt. So, do you think we're in a financial bubble right now? Which sector might explode in 2025? Share your thoughts in the comments. If you enjoyed this video, don't forget to hit the like button and subscribe to my channel. See you in the next video.